Well, hey there, and welcome to another edition of Retire Smarter. Walter Sorold here with Kevin Kroskey today, President and Wealth Advisor at True Wealth Design, and joining us as well, Certified Financial Planner on the team, Tyler Emrick. And we've got a great show today. We're going to be asking a lot of the questions that are probably on your mind as an investor, saver, and planner for your financial future, maybe for retirement. What are some of the top things people are thinking about? We're going to kind of talk shop a little bit on today's episode and discuss it all. But first, let's introduce you to the voices of the show. Kevin, I hope you are doing well, my friend. Great to talk to you once again.
Always, Walt. My pleasure. Off the July 4th long weekend, a lot of family fun. Looking forward to today.
Any fireworks involved on your side of things, Kevin?
Well, yeah, we did see some fireworks. I don't know, over the weekend. Unfortunately, our town here in Ohio, Akron, had to cancel their fireworks due to a very unfortunate event. I want to kind of derail things, but it's probably people are familiar with it if they're listening locally, and even if it's if they're not local, they may have seen it on the national news. But nonetheless, we had a good family fun weekend together.
Glad to hear that, and looking forward to your perspective on the show as always. Tyler, great to have you back with us once again. You been all right?
Yeah, I've been doing well, Walter. Happy to be here.
Awesome. Great to hear it. It sounded like you wanted to share a fireworks story. I could just feel it coming.
Nothing too exciting. Very similar to Kevin. Yeah, we just spent time with the family. I think we hit up like 3 different parks this weekend, which is always nice. I got a little toddler, so she loves running around, climbing, and I just chase her around and try to keep up.
That's awesome. Great to hear. Keeping you busy. Fantastic. Well, let's dive into things, guys. I got to think that one of the top questions on the minds of investors and folks that you're working with on a daily basis right now, and I'm sure a lot of our listeners to this show, is going to be with all of this market turmoil recently and the feeling that things just kind of keep going down, not really knowing what the future is going to hold. I imagine a lot of people are wondering, should we sell out at this point, or should we decrease risk? Kind of like, what should be that immediate move? Are you hearing questions like that? And if so, how are you handling them?
Yes, Walt. We're getting it quite a bit. As you can imagine, we've had a market that has been in pretty much a steady decline since the end of last year. So we're going on, say, 6-7 months of some pretty negative news. And I think you put that in perspective, more frequently than not, I think things like this happen, and we do have pullbacks. Kevin actually created a nice little quiz for the families that came in over the summer that kind of tested and brought to light like how often pullbacks like this happen. And when we walk through that quiz, I think some families have heard it before and they got it, but a pullback of say 20% or so happens. What was it, Kevin? I think twice or once every 6 years is what that quiz came out to.
Yeah, every 6 years, and then a 10% decline. At least the way this was constructed, about. It's pretty much a yearly occurrence. So volatility is normal, right? I mean, it's the same reason that we should get, higher expected returns from owning risky assets compared to safe ones.
Mm-hmm. But it probably doesn't make you feel any better when families are seeing their accounts drop like they are. And so we're really feeling that. And obviously, we hear that quite a bit, and we understand, and it's tough. I had a family that recently actually retired in January. As you can, obviously I hear it, but I think, from a timing standpoint, January we hadn't had much of a pullback, and then 6 months later you're trying to get acclimated to retirement, and then wow, you see your accounts down, quite a bit. So I think going through times like this now, probably more than ever, having some type of plan or some type of data that we can rely on to help take some of the emotion out of it, I think really helps. That family that I mentioned, they're in their early 60s, so by all intents and purposes, retiring fairly early. And we spent most of last year going through the numbers and really making them feel comfortable about the decision. And then wham, right? Market like this, and they see their accounts drop. And I think it was very helpful in their situation specifically, where we were able to pull up like the plan from last year and take a look, and we run what's called a bear market test on everybody's plan every year. And what that does, just as how it sounds, it tests against bear market and kind of says, well, how would the plan work, and would anything need to be changed if we've seen a very significant pullback in the market? And sure enough, when we looked at that report, the account values, they weren't down quite as much as what that report showed, but the account balances were down low. And then when we showed the results and the goals and them not having to change, I think it was very, very impactful in their situation, especially to kind of say, all right, let's look at these numbers, let's see how they look. We planned for this, and it really helps kind of go into these decisions and these meetings with a level head and kind of say, okay, we can get through this, because it's a challenging time. There's no doubt about it.
Yeah, the preparing is always incredibly important. I think with financial planning, with investment planning, you name it, just life in general. I've spoken from a planner anyway, whose mind works that way. But it's the often quoted Yogi Berra, making predictions, especially about the future, is difficult, right? So nobody has that crystal ball. Whenever we do go through the planning process, we kind of stress test the worst case fear of somebody feeling like their retirement causes a big bear market to happen. And Tyler's got a very recent case just kind of walking through that. But we have to plan. We can't predict. Sure, we may go ahead and kind of favor certain things in our investment portfolio in light of expectations, but nobody knows what's going to happen in the next 6 or 12 months. When you think about the question specifically, should we sell out or decrease risk? You just can't time the market like that. The biggest up days are always after the biggest down days. And if you're just out, for some of those, you end up missing a lot of the return for the market. So you kind of take the risk. You got to stick around for the return, said another way. And now I don't know what it is about investing, but it just always seems like it's this counterintuitive thing. I was, out shopping with my wife. We had my sister in town visiting us for kind of the holiday, and she was, so we have built-in babysitter, right? So, mom and dad are going to go out and get brunch together. We did a little shopping at the mall. I needed some work shirts, and I got these shirts at Macy's, and they were on a discount, and I put in a discount code SAVE, and I saved even more on top of the already discounted price. So, Walt, I don't know about you, but I felt like, man, that's a good value, right? And then, you look at when stock prices go down 20% like they have, broadly speaking, year to date, and, people start saying, oh man, should I get out? Should I do something different? Well, again, the forward-looking expectations now, look a lot better. Who knows what's going to happen over the next, 1, 3, 6 months or whatever. But the fact that they're cheaper today, all else being equal, meets higher expected returns going forward. So candidly, we would never sell out or decrease risk. It just, doesn't make sense, in response to something. Certainly, we may go ahead and change our risk profile, whether we're increasing or decreasing in light of future return expectations, in light of the client's financial plan, the return that they need, how much risk they can afford to take. But you want to be proactive. You don't want to react. If you react, it's too late. It's already in the price. It just doesn't make sense.
Well, and two things to add to that, Kevin. I mean, it's everybody can fall victim to this. Walter, Kevin was just giving me a hard time not 2 weeks ago because I said 6 to 12 months when I was talking about returns. So even I can fall victim, and us investment managers can fall victim to some of those emotional biases. And I think having some type of process in place is very important, or having someone like Kevin to bring you back and say, hey, you can't predict the market. Let's make sure we stay long-term and don't overpromise and try to pretend that we can do something that we can't.
Well, we knew, Kevin, that you were meticulous and very attentive when it comes to detail and those kinds of matters, but I never had you pegged for a couponer. So,
all right, this is going to be very embarrassing, but hey, if you can't laugh at yourself, well, life is too short. But back in the day when I was in college, my college roommates called me Kevin Kroskey because there was this Mexican restaurant that I loved that would always put these little coupons. And hey, when you're in college, you're on a budget, and us Kroskeys tend to be fairly frugal to boot. So yeah, coupon Kroskey. Even when I dated my wife, there used to be, I'm sure a lot of you probably remember something called the Entertainment Guide. I would buy that book and I would take Tyler's like, oh no, she married you after you did this? Yes, she did, Tyler. She's cut from the same cloth. But I took that out on our first date as well.
Oh,
That
Walter,
is
he used
awesome.
to give me Walter used to give me so much trouble about showing a goat at the county fair. So now I got coupon Kroskey in my back pocket.
Yeah,
I'll
you're
tell
in
you
good
what,
shape, my friend.
just building up the ammo. So no, this podcast has been well worth it already.
Hey, a dollar saved is a dollar earned, right, Kevin?
Yeah.
Amen.
That's awesome. I love it. All right. So risk, obviously, big piece of the puzzle. People are wondering about, talking about it. Lots of questions in that realm. I imagine something else that's kind of stirring up in people is kind of this conversation about cash versus bonds. And I mean, I just feel like bonds are kind of getting, trashed in the news right now and saying, boy, people, if you're holding bonds, you're in big trouble. That seems to be some of the messaging that I've seen out there. Is there a reason to still hold bonds over cash in a moment like this? Are you guys getting questions about that?
Sure. I tell you what, we'll take turns here, Ty. I'll start this one. But, if everybody holds some cash, right? So, there's already cash, whether it's typically down at the bank, maybe a little bit in your investment portfolio. The academic studies will show over time there tends to be a pretty high cost to holding cash. They call it cash drag or something of the sort. So we're not big proponents in just holding hordes of cash. Just more of an appropriate amount. An appropriate amount can vary for different people, but I'll put this in the context of the retirement plan. Whenever we're doing those stress tests, like Tyler just mentioned, we need to know where our income is going to come from for the next few years. So, if you have say an incredibly well-funded retirement plan, kind of a Fort Knox plan, if you will, then maybe you don't need any more cash than kind of just what you have in your bank account to facilitate, kind of monthly expenses. And maybe you can be all stocks, but, most clients, we have a lot of clients that they can't afford that luxury and do need to have some, higher quality assets, cash, bond-like assets that they can draw from. So, whether it's, the money that you're going to need for the next 3 months or 6 months or 5 years, typically that's not coming from the stock portion of the portfolio. And as you go out in time, you can, you think of interest rates in terms of mortgages is probably the best example I can think of. Everybody's had a mortgage, probably over the lifetime. Walt, what can you tell me about the relationship between the 15 and the 30-year mortgage? Which one's higher typically?
You're going to get the higher interest rate. It's going to be the 30.
Yeah, so 30 years. So if they're going to lend money for a longer period of time, you're going to pay a higher rate. And, kind of the fancy phrase for this is kind of the yield curve. So shorter term rates are typically lower, and then you go out to longer maturities, be it 15 or 30 years, and the yields tend to be higher. That's almost universal, but there's, certain moments in time when maybe that's not the case, and you may hear the phrase yield curve inversion or something like that. But as you relate it...
I thought that was my computer messing up. I was like, oh no, I ruined the entire podcast.
It caught me off guard, Walt. Okay, well, I'll take it. Coupon Kroskey or own that one. But my point in bringing this up is, typically you can think of, maybe a 5-year bond, providing your income in 5 years out, that over time that will generally provide higher return on the bond portion of your portfolio, kind of matches your assets to your liabilities or your cash flows. But in general, it works. You definitely don't want to hold cash from a market timing perspective like we talked about. But, if you're in retirement or close to it, your money has a purpose and it's always kind of matching in it to those lifestyle spending goals, anything that's not being met by your Social Security or pension. What do you think, Tyler?
No, I ditto everything that you had mentioned. I would add the point that when you think about retirees' income, and some families, I'm sure they're listening to this, have some type of like automatic distribution set up from a 401k or an IRA, and they're receiving that distribution on a monthly basis. Having the ability to go in and say, well, what type of investment or which mutual fund or ETF inside of my account am I actually drawing from and pulling in that from, I think becomes extremely important in times like this as well. And the question becomes is, do you have that capability inside your accounts? I know some 401k plans, they do what's called aggregation rules, meaning that it has to pull equally from all investments inside of the account. Or do you have it set up maybe in an IRA and it's pulling from the stocks? Well, you maybe alluded to it a little bit there where you said, well, do we want to be selling out of the stocks right now? Or would there be other investments that you hold that would be more keen or better places to potentially pull from during this time? And that's really all I think I wanted to add on that one.
Yeah, I guess the one other thing that comes to mind too when I think of this is just, I mean, if you're putting money in cash right now, if you have money in cash, you're with inflation being as high as it is, you are losing money. I mean, you're not losing your principal, but you are absolutely guaranteed losing your purchasing power because inflation is increasing, at an annualized rate around 8% or so. And, maybe you're earning 1% on your cash yields. And, if that's in a taxable account, then you're paying tax on that. So, you're definitely losing money on a purchasing power. And that's one of the things that, I don't know about you, Tyler, but I've just found it's kind of reframing for a lot of people when they initially start this retirement planning journey and thinking about this and they think they may need to preserve their principal, and I quickly just educate them and say it's really about preserving your purchasing power and making sure that you're able to maintain the lifestyle that you become accustomed to over all the years that you live.
Well, and two, I think it was a couple of years ago when we went through March of 2020 and the COVID hit, and the S&P 500 I think fell quite a bit more than what we have seen here over the last, say, 6 months, but it was a much faster drop, shorter time period lived. But during that time, when the families were coming in and we were updating plans, one of the comments that we actually put on our meeting agendas when we met with the families was, giving them an idea of how much of their portfolio was in those more interest-bearing or safer accounts that tend to have less volatility, and how long could they specifically pull from those positions inside their accounts. And I think some families had upwards of 8 to 10 years, if I'm remembering correctly, of money just from a diversified portfolio that they could pull from before they ever had to dip into the actual stock piece of their portfolio.
Yeah. Said another way, I like to call this runway. How much runway do you have before you have to start selling stocks? Mm-hmm.
Great points across the board, guys. So we've got conversations about cash, bonds, decreasing risk. What about, I can imagine with the volatility, with things going in a negative direction for many people, maybe there's some interest in more predictability. So what about fixed interest rate products right now? Should those be considered? Are you getting questions about those as well?
I know I am, Kevin. I mean, I think it's only natural to think that way, especially as you see your accounts go down. And it's like, thinking, well, should we consider those fixed rate, we'll call them products, CDs, fixed annuities and things of that nature. And I think when I start a conversation around that, I think it's always important to go back to the, why, what's changed, and, why are we considering these when we didn't, say last year or the year before, when maybe the markets were in a little bit better place. And not only the why behind it, but how does it fit into that plan? You hear say plan quite a bit on the podcast. And I think when I joined True Wealth over 4 years ago, I think that was one of the things that was very, very appealing to me was, all our decisions, investments included, all come from a plan, right? And what does that plan tell us, and how can we use it to better make decisions? And, when you start, committing yourself to these fixed products, you're giving something up. There's a cost to that to get that fixed rate of return. Sometimes that's in the form of rate of return over the long term. So when you look at your plan, what rate of return do you need to get on your money to make your plan work? And do those two numbers jive? And not only that, we got to look at it from a liquidity standpoint. A lot of times when you start talking about fixed products, again, you have to give up some type of liquidity to get that fixed rate of return. How does that giving up that liquidity fit into your cash flow needs and your overall portfolio, and not really losing sight of that big picture?
All really good points, Tyler. One of the things that always makes sense to remind people too is just like, hey, obviously, bonds and interest rates are kind of inverse. It's like a teeter-totter relationship. So as interest rates have moved up pretty swiftly this year, obviously bond prices have come down, but those yields are a lot higher now. And so it's now we're investing today in those types of bond type investments where you can expect a lot more going forward because the yields are higher. And studies will show that the starting yield, or technically the yield to maturity, will explain more than 90% of the return that you're going to get, over that that horizon. So, it's to go into a fixed rate product. Candidly, there's part of me is like, oh man, somebody went to a slick indexed annuity or fixed annuity sales event. But if you're going to use a type of investment like that, and not like it's terrible. I mean, we have some clients where they do have some of those preferences. They don't like seeing that kind of move around, and we'll present them with a couple options. But if there's an insurance company that's in there, obviously they're going to be making their spread. Then they're going out and buying the underlying bonds that you could buy yourself. So now there's more cooks in the kitchen, and generally speaking, over time, that's going to mean fewer dollars, fewer pennies resulting to the end investor. So everything moves. Nothing stays fixed. Interest rates move around like we've seen. Yields move around. Stocks certainly move around and have a much bigger wiggle factor. But if we can always just come back to the plan and just kind of think about whether it's the retirement plan or the investment plan, and we have a purpose for every asset that we own, and we know where income's coming from, the first half was tough, but prospectively, I think things are going to look a lot better for fixed income investors. We saw something similar. You may remember back in I can't even remember, these years kind of meld together over time, but the Fed taper tantrum back circa kind of 2013 or so, when they started raising rates pretty quickly. And bond returns were quite a bit negative for part of the year, and then they earned quite a bit in the second half, because now the rates increases really kind of petered out, and we now have those higher yields. So it's not all bad news for bond investors. It was certainly a tough first half of the year, but prospectively, things are going to look a lot better. The only case would be obviously if they continue to move in the direction with the pace that they have, then certainly we could experience some more pain. And while we can't predict that, I think the market has already priced that in. It's only a new surprise that would further compel those rates to go higher and drive bond prices down further.
All good points across the board, it sounds like, guys, and I know we've covered a wide array of topics so far. Maybe perhaps we can move in one more direction, and that would be just the general conversation about moving money. I mean, is it a bad time to do that? Wouldn't you be selling investments at a loss if you were to do that? Or how can you do it effectively? How do you navigate those waters with folks?
Great question. I just had this come up a couple of times in the last week. So I think there's a bit of an opportunity here. Again, whenever, let's say if we have a new client that is, moving, assets over to us, we're starting a relationship. Those assets, come over what we say in kind. So they own everything that they own now. It transfers over, or, maybe they already hold assets at TD Ameritrade, Fidelity, Schwab, Pershing, all custodians that we work with. And they just appoint us as advisor to that. And then we can go ahead and kind of begin to incorporate what they currently own into what we feel that they should own. That's ultimately going to be tied back to, their financial life plan. For anybody that has assets outside of a retirement account, I really think it's a great opportunity, because, you may own some things that you maybe don't want to. There's some tax losses to be realized, and then we can more efficiently, reallocate in a better portfolio moving forward. So we have a few of these right now where we're kind of working through. And I don't know about you, Tyler, one of the things I get into sometimes is somebody kind of bought and they're seeing these losses, and maybe they had for some things that they purchased, particularly more of the growth-oriented stocks. And they're like, well, should we just wait? And, ultimately things are kind of repriced, and the market, factors in all those expectations. But it's not like we would ever get somebody out of the market necessarily and reinvest. We're making a transition pretty efficiently, so we're not having those gaps. But what have you been dealing with, Tyler?
Right. Well, and as you think about that, it's really asking yourself, again, I think it's been proven, and there's a lot of data out there that we can't time it, the market, and putting a short-term hat on and thinking that way, and saying, hey, if it's fallen a lot, I think you mentioned the tech or growth-oriented stocks, it's got to bounce back at some point, right? And I don't necessarily think that's the right approach to take. I think it's more so, hey, let's not get caught up in the short term. Let's think long term and say what type of portfolio is going to position me and put me with my best foot forward going forward. And it's hard to think that and take some of that emotion out of it. I think we did a podcast a few weeks ago on some of those emotional, we call them biases or mental traps, and that would be one of them that I think we discussed, but always want to be thinking long term.
Yeah, and if somebody has, I don't know, just say hypothetically they had a 60% stock target or, a portion of their portfolio before we started working together, then they come over and maybe we maintain the same amount of, overall stock risk, hypothetically, but we may just prefer to own some different assets. So it's not like we would necessarily change it unless it was truly imprudent or, as it's kind of dictated from the financial plan. Again, it all comes back to that. What's the required return that they need? How much capacity for risk do they have? What are return expectations as well? Certainly as stocks and bonds have sold off, expectations for both are now higher. But then also
simple rebalancing, Kevin, right? I mean, just having an opportunity to rebalance the portfolio. I find so many families, I think, lose sight of that, and that's like such an important tool. I mean, the vast majority of performance is going to come from simply rebalancing the accounts and ensuring that risk level is maintained.
Yeah, and nothing is, kind of formulaic necessarily. I mean, we had a client that took a sizable distribution for a house closing recently, and they were concerned about, oh no, we're selling and we're taking the money out when the market's down. I said, no worries, we're not locked into this. We can be flexible, and ultimately what we did, we took from some assets that had been up in price, and we kind of tweaked their portfolio to maintain a similar dollar allocation to stocks, but it was now a higher percentage of their portfolio. But we kept the same dollars invested in the stock asset classes that had declined the most. So, nothing, you can always kind of think through this. I'd say the only thing you maybe have to be a little bit cautious about is if you're rolling money over from a 401k and you can't do that in-kind transfer. The market's not incredibly volatile right now, but if it were like during the periods of like March of 20 or 2008, 2009, it's the same reason, like we said before, why you don't want to go to cash. The biggest up days come after the biggest down days, and you just got to need to be a little bit more careful there. So I don't think we're in one of those environments right now, but if things did get that volatile, sometimes we will do that in just, maybe 2 chunks or something just to diversify the risk, or just wait till markets calm down a bit.
Well, that's all the major questions that I had for you guys. Any other reminders or to-dos that people should kind of have on their list over these? I don't know, what's our timeline, like next couple of weeks or months, or I guess we're just in a period where we'll kind of have this heightened sense for a while while the market's so wonky?
Yeah, if we had the crystal ball, we could tell you the timeline. Well, but there's always things. I mean, what we say is generally for our clients, the 3 things we do year in, year out. We do their financial planning, their retirement planning. We do their investment planning, make sure that's tied back to their financial plan and keeps them on track. And then we do their tax planning and tax prep, so that it's always ongoing. Whenever markets sell off, there are some tax loss harvesting to be done, similar to what I kind of talked about in kind of making a transition and maybe pruning the portfolio a little bit. Certainly I remember March of 20 and we executed a lot of Roth conversions after the market had sold off. I think, kind of got it going in March and executed in April. So we're not doing that just yet for some different reasons I won't go into, but you kind of keep an eye on these things, and maybe you need to fast forward some things you're planning on doing in the fourth quarter to now, but it's always those things, and you push on one domino and the other 2 are going to fall over too. But it's all those things you kind of got to keep in front of you. You got to take a very logical approach to what you're doing, a very process driven approach. Make sure you stay on track. But we talked about some income planning today and some questions that people have. But if anybody wants to listen more, we did a series on retirement income planning. It's kind of related to much of what we talked about today, but I think that was back in 2019. It was a 4-part series, and I know a lot of people have listened to it and have brought it up in conversations we've had over the years. That might be a good next step if somebody wants to learn more.
Well, thank you, Kevin. Appreciate that. And you can also always schedule a time to meet with an experienced advisor on the True Wealth Design team by going to truewealthdesign.com and clicking on the Are We Right For You button to schedule a 15-minute call with an advisor on True Wealth. Again, you can do that by going to truewealthdesign.com and click on the Are We Right For You button, or you can call the old-fashioned way, 855-TWD-PLAN, 855-893-7526, and that contact info is in the description of today's show, so you can find it easily as well. Tyler, Kevin, thank you both for the help. We got Coupon Kroskey out of today's episode. Fantastic. Maybe we need to make a little liner for that. Whenever you talk about like saving $1 or something like that, Kevin, we can trigger the...
I'm okay not advertising that. I mean, it's out
like
there.
It won't.
All right. We'll just keep the egghead alert then, and let that still be the one in our back pocket. Well, thank you guys. We appreciate the help and the time, and thank you so much for taking time out to listen to the show today, folks. And we'll see you again next time right back here on Retire Smartly.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.